Hello and a warm welcome to everyone from across the globe who's dialing in today. For those of you who've not met me before, my name is Hannah and I'm the Head of Sales and Investor Relations here at Rest Capital. In this second webinar for the year, we will go through the content of the Q1 investor report that was published earlier today. Towards the end of this webinar, we will open up a Q&A for those of you who have individual questions that you can post using the Q&A function within the Teams application. For today's discussion, I'm being joined in the studio by CEO Gustav Hagerud, Anton Puzin, who is our Head of Portfolio Management, and last but not least, Jonas Mårtensson, who founded the company. So welcome to you as well.
Thank you very much.
I'd like to start to look at the performance together with you. As you can see in this table that we've taken from the report, the first quarter ended at a net positive performance of 1.5% in US dollars. Gustav, could you please share some of your high-level thoughts and comments on these numbers?
Absolutely. Thank you very much. It's only a quarter, which is a short period for the fund, but certainly I will make some comments on the result. And the first thing to note is that we have had some maturities during the quarter, which has affected the performance positively. Secondly, and this will be discussed by Anton later today, is that we have sold policies, and some of this has been sold at the valuations that we had at the end of 2023, but some has also been sold on a value higher than the net asset value. And this is another source of positive performance to the portfolio. And thirdly, we have not seen any general changes in the valuation of policies in the secondary market for US life insurance policies. So there is no effect of valuation changes of policies in Rest Life investments. If we look at this graph here, and this shows the performance of Rest Life investments compared to a number of well-known indices, and the first one to note is the S&P 500 on the top in black. You have the MSCI World in US dollars in blue. There is a hedge fund index in green, and then there is the Bloomberg fixed income index in yellow. And the conclusion you can draw from looking at this 10-year history is that Rest Life investment has during this time delivered according to the characteristics that you would expect for a portfolio invested in US life insurance policies. And firstly, uncorrelated to other asset classes, and it's quite clear that if you look at the graph that's the case. Very small volatility in this particular series is 3.6%, and then thirdly, we don't have any big drawdowns during this period. Unfortunately, and this you saw this on the previous slide too. The return of the fund, the annual return of the fund during this period is 6.1%, which is slightly below our expectation. And this is partly due to the fact that the performance during 2023 was 1.6 rather than the 7 that we expected. And this is something that we discussed in our previous webinar. We expect that we will be compensated for the low return in 2023, and this will be in the coming 2 to 3 years.
Thank you, Gustav, for that very detailed overview. I'd actually like to go back to the performance of 2023 before we move into Q1 and discuss more what happened in the market and in the portfolio. So during our last webinar, we discussed the performance of 2023, and we couldn't really disclose the full attribution report because the data was published at the time. Now the financial report for the fund has been released, and that includes a very detailed performance attribution analysis, which we have shared in our report. So, Anton, could you please take us through this table and discuss in detail the various line items and give your key takeaways from what we're seeing?
Thank you, Hanna. So I have three main takeaways from the performance attribution. The first one is the realized performance, which is on the top row of the table. As you can see, in 2023, at 2.1%, it was more than 10 percentage points below the 2022 number. As Gustav explained, mainly because less policies paid out during 2023. The second takeaway is the MTM adjustment, which means mark-to-market adjustment, which is basically us trying to make sure that our portfolio is valued at or close to the market valuations. And as you can see, in 2023, it was minus 0.6%, which is still a negative number, but a smaller number than in 2022. So we can draw a conclusion that the trend is sort of changing, and it is consistent with what we can see now in early 2024, that the prices have stopped going down for the policies in the secondary market and are now more or less stable, and we might even see a slight uptick during 2024. And the third takeaway would be that all the other item levels have stayed more or less consistent over the last several years, so no big changes there.
Thank you, Anton. I think this is a great way to look at the performance and understand the drivers of return. Gustav, if I turn to you with your macro background, one of the things to note here is that the change in discount rates or the mark-to-market hasn't really been impacted that much compared to some of the other asset classes in recent years. Could you talk us through the rationale behind that?
Absolutely, and this is a question we get frequently from clients, and particularly during the last 2 years when interest rate and bond yields has moved up. And the explanation from our side is that the market for used life insurance policy is a niche market, and it is not the connection between our market and the valuation of equities and bonds is really weak, and it really depends on the supply and demand of policies in the market. So if you look at the supply side, that's coming from individual US citizens selling their policies, and generally they are not very price sensitive. It is important for them that they are compensated when they sell their policies, but the main decision that they take is that they don't need the policy anymore because they have reached an age of, in average, then 78 years old in our portfolio. And particularly, that decision is not affected by the valuation of equities and bonds. So that's the supply side. So if you go to the demand side, so that demand side is then coming from funds like Rest Life Investment and managers like Rest Capital, and we are managing money for our clients. And the important thing for us is that we make sure that our clients are compensated for the main risk in the asset class, and the main risk in the asset class in longevity risk. And it's just a fact that in the life of the fund, that compensation to longevity risk has been very stable. So we didn't see it mow down when interest rates were close to zero, bond yields were close to zero, and we haven't seen that change in the last 2 years with interest rates moving up and bond yields moving out. So that's my short answer to that question.
Thank you, Gustav. I think that is really clear, and I think this is a key aspect and important to understand about this asset class. Anton, Gustav is mentioning this is a niche asset class, which is very true, and it's not really covered by media. So if you could share a market update with you based on your experience and conversations.
Sure. So during this winter, I would say that the market saw a general slowdown with fewer policies being sold in the secondary market to investors like ResLife Investments. And this is consistent with what I hear from our brokers. That generally fewer policies were sold. We did see an uptick in transactions during later half of Q1. So I think the trend has broken, and we will see more transactions during 2024.
Thank you. I know you have done some trading in the quarter, as was mentioned earlier. And based on my experience talking to clients, this is something that sometimes comes up as a concern, that it could potentially impact the portfolio composition and later on ultimately the performance. So could you please go through some of this in more detail?
Sure. So we have both sold and bought policies during 2023 and during Q1. We did sell a larger block in Q2 of 2023 and again another block in Q1 of 2024. And so I wanted to show our portfolio composition. Here you see some charts that compare in red the portfolio composition today and in yellow staples from end of 2022. And some additional numbers were published in the quarterly report earlier today. So if we first look at the chart in the top left corner, which shows different frequencies of face values in our portfolio, we can see that there has generally been no change in the last year and a half. If we look at issuing carrier states in the top right chart, we can see that, Florida went up a little bit and California went down a little bit, but generally the portfolio composition hasn't changed. If we look at the lower left chart, which shows age distribution in our portfolio, we see that we have a bit fewer policies for really young insureds below the age of 65. We have a bit more insureds aged 70 to 85, and then again a bit fewer 85 to 94. But the average age in our portfolio is 78, which is the same it was in end of 2022. Again, if we look at the life expectancy chart in the lower right corner, we see that life expectancies haven't changed much. We have a bit fewer policies with really long life expectancies above 16 years. But the average life expectancy in the portfolio is 10 years, and it was the same in end of Q4 of 2022. So basically, the portfolio composition hasn't really changed much.
Thank you, Anton. I think that's very detailed and very clear to everyone. If we then look at the overview of the portfolio today, is there anything in particular that you'd like to point out there? I
would just like to mention that we add policies to the portfolio, we sell blocks of policies, but our portfolio composition stays more or less the same, because our goal is to stay true to our investment philosophy, to buy policies with low tail risk and generally create a portfolio that delivers a stable return over time.
Thank you, Anton. I think this concludes the discussion with the two of you. So I'd like to thank you too, and then invite Jonas to the discussion now.
Thank you very much.
Hello, Jonas. Thank you so much for being here today. I know you came back from traveling very late last night, so great to have you here. And this is also what I wanted to discuss a little bit with you. You've been on the road quite a bit during Q1. You've been to Singapore, where you've held presentations. You've been traveling much in Switzerland. And as always, you've had lengthy conversations with investors in Scandinavia. So based on those discussions, I was curious to hear some of the takeaways from the discussions you've had with clients.
Thank you, Hannah. Well, I think there's quite a big change from last year and this year. The investor sentiment is certainly changing, so see quite a lot of changes. Last year, when US interest rates were increasing, our 7% net return strategy, which of course is uncorrelated and very interesting for long-term investors, was relatively speaking less attractive. And we saw some of our potential investors questioning whether this was interesting to invest in. And the answer was really that this is a long-term strategy which delivers truly uncorrelated returns. But obviously, it was slightly more difficult for us to convince new investors last year. So we've seen a marked change now this year. My recent trips where I'm speaking at conferences and meeting new investors is quite different from last year. We are now facing a situation where US interest rates will decrease. No one knows when, which is the big question. But the fact that we have peaked, and this is really something positive for our strategy. So investors are now beginning to be more proactive, looking at alternative investments, looking at strategies which can deliver over the long term. Parking all your money in cash at the bank is not a strategy, in my belief, so my opinion. And that's what we're seeing right now, that there is certainly much more positive attitude for this asset class.
I'd like to copy that from the discussions I've had recently with clients as well. Some of them also mentioned that other asset classes start to look expensive, or whether sort of risk-reward ratio is off what they are looking for. So yes, definitely an increased demand for alternative uncorrelated assets. As a last question, Jonas, I'd like to ask whether you dare to share your expectations on the outlook from here of this asset class.
Yeah, I think the outlook is quite positive. If we look at the secondary market, I mean, volumes have remained fairly stable. It's a slow increase in transaction volumes year after year. The asset class is still relatively unknown to many investors. So many times when we present this life insurance strategy, it's completely new to our investors. So we have a lot of education on our part. We try to participate in conferences and really spread the word about the asset class. Rest Life Investments now has one of the longest continuous track record in this asset class. And this is something that we are very proud of and grateful to our investors who have been very long term. So for us, 2024 will very much be to spread the word about the asset class, and we see an increasing interest and we are very positive for the outlook long term.
Thank you, Jonas. I'll let those words conclude the discussion of today on the report and go over to the Q&A. So to give everyone a few more minutes to post their questions, I'm going to start by addressing some of the questions that we received over email. And the first one is related to the financial statements. Looking at the financial statements for the fund, treasuries decreased quite significantly from the end of 2022 to the end of 2023. Is there an explanation to that? What's the current cash or cash equivalent position? This is going to be a question for you, Gustav. Please join me.
Okay, thank you very much. Yeah, so looking at the financial statement for Restlife Investments at the end of 2023, it's quite clear that the cash position at that at sort of end of December 23 was smaller than the one we had in the previous year. So it's 16 million relative to 50 million. And the reason for this is that we actually had fewer payouts of policies during 2023. The aim of the fund management is to have between 5 to 10% of cash and cash equivalent, so that would be T-bills in the portfolio. And so 60 million, that would be around, just over 4%. So, and as Anton explained previously, we have sold policies during Q1 in order to strengthen the cash position. So, in that sense, the 60 million that we had in December, it was one of the reasons actually why we sold policies. So we can't disclose, I guess, positions in the fund currently. That would be, I guess, our holdings in insurance contracts or cash or T-bills. But what we can say is that at this point in time, we are satisfied with our positions in cash equivalents, so that's cash and T-bills.
Okay. Well, thank you, Gustav. The next one is somewhat related, but I think that's more for you, Anton. So if you could join me here. And that's, what's the reason for selling large blocks of policies?
Well, thank you for the question. Obviously, as an open-ended fund, we both buy and sell policies, and we sell policies as part of our liquidity management. And I mean, in 2023, we received about 7 million in proceeds from matured policies, and that's compared with almost 70 million that we received in 2022. So obviously, as a part of our liquidity management, we sold a block of policies. I can say that I was very happy with the fact that we were able to sell blocks of policies at net asset value or above, which means that we are doing a good job of valuing our portfolio according to the market prices.
Yeah. You can stay with me. I think I have another one here for you, which is related to fund performance and what's the effect of GLP-1 medications such as Ozempic on your fund's performance? Could you comment on that, Anton?
Sure, that's actually a good question, a very good question. So the way GLP-1 drugs such as Ozempic and Wegovy, and for, well, maybe some viewers don't know, so GLP-1 drugs are drugs that have recently come out to combat diabetes type 2, and they can also be used as a weight loss medication for obese people. So I think in order to understand whether they have an impact on a life settlement fund such as ours or not, it is important to look at the demographics of users of GLP-1 drugs. So, and we have done that. We have collected the data, and it's obvious that it's not the same types of demographic groups. So basically, main users of GLP-1 drugs are people born in early 60s or later. So basically, Gen X, millennials, Gen Z are overrepresented, while baby boomers and golden generation are underrepresented as users of GLP-1 drugs. So our portfolio has a mean age of 78 years. Another thing that we noted was also that demographic groups that are less wealthy are overrepresented as users of GLP-1. So, and we have older, generally healthier and wealthier population as insured in our portfolio. So obviously there will be an impact on life expectancies in US and in the world, which is a good thing, but I think the effect or impact on our portfolio performance will be minimal or not at all.
Okay, thank you, Jan. I think the next one is a question for Gustav. So, do you have a view on the Fed fund rate? Do you?